Businesses are abandoning the CBD. Let's have a look. Hello everyone, Florian.heise here, and welcome back for another episode of HeiseSays. I'm still working through my stein of coffee, and I thought we'd have a look at this article from commercialrealestate.com.au. This one's discussing businesses in office spaces are giving them up or abandoning them in this CBD. Now, I thought this was quite interesting because I've been discussing this in several videos, just the cultural changes that we're going to start seeing coming out of people adapting to working from home and realizing that commute really is a pain, Before we have a look at this, let's jump over here to the Property Council of Australia, their data room, and it's becoming one of my new favorite websites, just for all the information it has, You can look at the economy, hotels, non-residential industry. We'll click on offices here to have a look. And we can see the office stock levels. And, let's move around. The current total Australian office net lettable area by the market. We can see Sydney is huge. It's the big office. Sydney and Melbourne really dominate our commercial office areas here in Australia. Then you've got Canberra, Brisbane, and then Perth, and then it just drops down. Well, you've got Brisbane, we've got two. We've got inner and outer. Inner and outer. I prefer that outer ring. Cheaper rent. Cheaper rent. Jump on a train in the city for meetings. That's what we were doing. Now, let's have a look here. We can see at the office vacancy rates. And this is for Australia overall. And in January 2020, it was an 8% vacancy rate. But have a look here. See this hump? This is the recession Australia had to have. 92, 93, 94. After the recession, the vacancy rates kept climbing. Now, the argument I'm putting forward, because we are now living in a much more advanced time than back in the 90s, we've got more access to technology. We've got, I'm talking to you here on YouTube, guys. People can work from home. We can have remote meetings. I would argue there's going to be less demand, or at least less demand for area in the city for offices. I think people are going to look at other ways. I had a meeting. I was having a coffee once with a gentleman, and his entire business had no offices. They had actually developed an app. It was like 30, 40 staff. They developed an app where they would log wherever they'd find free internet, free places to work, and they could find it and share it with their own team members. This is a decent-sized law firm. I thought that was quite fascinating, avoiding that cost. Because office space, guys, is not cheap. It is expensive to rent. It's another ongoing cost. And that's one thing you can cut and you can save. So there's going to be, we'll see, there's a decline in demand for offices. People are leaving these office buildings. There's going to be more competition from these owners of these assets to attract tenants. There are going to be more incentives. They're probably going to have to spend more money upgrading their buildings. So there could be some market opportunities there if you're in the construction game, guys. Get on your phone, start making phone calls. When the restrictions disappear again, get the networking happening. So we'll see, guys. We'll see. So the amount of office space in the Sydney CBD available for sublease has hit its highest levels since the early 1990s recession and is expected to expand further this year as businesses contract or look for ways to save money as a result of the pandemic. So, businesses are going to contract, guys. We're entering a recession. This is going to happen. No matter how much people don't want difficult times to happen in the economy, they don't want us to be resilient civilization. It's going to happen to some extent. And businesses are going to look for ways to save money, definitely. If you can cut your rent down, guys, who wouldn't? The large increase in sublease space has so far been mainly attributed to businesses relocating, but CBRE expects that demand will deteriorate further as a result of higher unemployment, lower migration, and rising incentives. Falling demand could cause effective rents to drop by 15 to 20% in 2021, in turn putting office tower values under pressure. And there you go. This is one thing I didn't realize, guys. And this is probably a financial mistake I made when we had a commercial premises. Well, actually, no, it was technically a retail premises. We had a shop front. And we were given an incentive to stay on to sign another 3 years at that rent. And, we've got a couple of months extra. And I thought, oh, fantastic, I'll take it. I probably shouldn't have, because I didn't realize that it's adding value to their asset just by having me there. I should have negotiated a lot harder with having an appreciation that by signing that contract, I was giving them money just by being there before I even paid any rent. It's increasing the value of it because they went to on-sell the whole center. There you go, live and learn, guys. If you've got any hints for people who are in business, please share them in the comments, advice like that. Of real concern is that sublease availability is at historic highs, and that is before we see the anticipated distressed space hit the market, the CBRE research team said. So we are already seeing a market in trouble, everyone. I mean, how many of you have been driving around seeing office space signs for lease, particularly in the B-grade stock? They're going to be businesses that are stepping down from the A-grade stock to the B-grade stock, and there'll be some, let's see, just say perhaps a generation of workers that are used to some amenity that they may have to sacrifice. There's definitely more coming in the next 6 months. It's as a result of tenants that may have carried extra space when times were good, and they planned it for growth, but now the growth is unlikely to occur, and so they will now look to cut costs. CBRE's Director of Office Leasing, Chris Fisher, said, even before the pandemic struck, the market was softening, with sublease space in the Sydney CBD at a 7-year high in the first quarter of 2020. Well, let's jump over to the property data room and let's see what that manifests here. We'll look at Sydney. There you go, still low. Oh, this is total of vacancies, not sublease. So it tracked even higher by the end of April, with 90,000 square meters of surplus space available in the market, well above the long-term average of 54,000, according to new data from CBRE. The last time the CBD market had that much available space to sublease was during the early 90s recession, when levels peaked at 119,000 square meters, according to the Property Council of Australia records. So the last time we hit that high was was the result of the recession Australia had to have. We're already sitting at 90,000. Sure, though, the amount of commercial office space in the CBD would have grown since then. But that's nearly a 50% increase on the average. What's that telling you where the market was sitting? Maybe some sectors certainly were in recession. Because remember, when they say Australia's in recession, they're talking about the overall economy. I guarantee you some sectors already have been. According to CBRE's latest sublease barometer report, an increase in sublease space combined with an increase in direct lease space will see CBD vacancy rates rise to about 6% mid-year and increase to about 8% by the end of the year, should businesses not bounce back as quickly as forecast. Subleasing data paints a more complete picture of the overall health of an office market by revealing just how much space in the CBD is fully occupied by businesses, which is otherwise hidden by the headline vacancy rate, which as of February was below 4%. So there you go. People are stuck. People are stuck with these office leases, and they're just trying to get someone in to reduce the costs that they're paying. And that can be difficult. I know when we tried to get out of our lease, I had to do the same thing. And I think we had, in 2 years, two people look. Well, in about a year. So, and there was lots of empty office spaces there. Well, that's one thing. Moving the business back home to here in the studio out the back is probably the smartest thing I ever did, just for reducing ongoing costs. It's nuts. Several large swaths of Sydney CBD office sublease space have become available in the past couple of months, with Telstra looking to offload 5,000 square meters at its offices in Sydney at 400 George Street, Macquarie giving up 3,900 square meters at 80 Pitt Street, and law firm Ashurst shedding 1,200 square meters. In Brisbane, Allianz has decided to sublease 1/3 of its premises at 310 Ann Street for the rest of its lease term, only 2 years in, while St George Bank is looking to sublease an entire floor, about 1,900 square meters at Waterfront Place. It's a nice location, but there you go. That's a lot of square meterage thrown on the market. Tenant representative Steve Irwin of Cornell Properties expects effective rents to comfortably drop by 20% this year. 20% this year. So we've seen the retail sector having to, well, we've seen rents fall in the retail. We've seen rents falling in residential. Now we're looking at rents falling in commercial by 20%. And these guys are normally used to just getting another 10%, another 5% every year. It's time to go to the negotiating table, guys. I'm convinced this is the thin end of the wedge. It has barely started. Some of the bigger players are only now starting to finish their office reviews, tenants representative Steve said. Initially, it won't flow through to building values because the sublessors are still obliged to pay rent. However, landlords to do deals now have to compete with a new market, so new deals will effectively be reflected in valuations. And once there they are, it won't be a quick fix. So cost-cutting decisions. Knight Frank, head of leasing, Andrea Roberts, said there'd been an increase in sublease space across the country, with the exception of the ACT. Well, yes, we'll just jump back here and we'll have a look. Have a look at Canberra. Just look at Canberra, guys. Look there, see? Recession-proof. Recession-proof city. It will certainly increase in the next few months, but we're only in May now. Organizations are first assessing where they are in the return to work space, and then they will start to make decisions to put certain amounts of space, if they have that excess, on the market. It will increase over time because people will make cost-cutting decisions once they get to a back-to-work position. Ms. Roberts said, while excessive supply created rental pressure, which was a concern, there would in fact be some opportunities depending on how long ago leases were struck for sublessors to profit from rent off the back of strong rental growth, particularly in Sydney and Melbourne. Yeah, we'll see. I think that's going to be a rarity, guys, if we're looking at 20% cuts. And there will be some opportunities for the refurbishment and construction of these sublease spaces. But I imagine that'll be pretty much tied up by the players in that field. Then again, get on the phones. If you're in the trades, it can't hurt, guys. So, what do you think? We'll have to keep an eye on this sector. Another sector taking a hit. As always, thank you for watching. Please like, share, and subscribe. Leave your comments down below. If you're a fan of the channel and you'd like to support us, there are a few ways you can. You can join the channel here on YouTube or Patreon. You can support us via using our affiliate links at Amazon or eBay or Independent Reserve and Kucoin. You can buy a merch from HeiseSays. You can use gold paths from the Perth Mint, or you can support us via PayPal. Take care, everyone. I'll see you in the next video.